Welcome to Financial Accounting Basics Part 1. Let's get started. We know from our previous modules that the purpose of accounting is to help people make decisions. We've studied a little bit about management accounting or managerial accounting, and managerial accounting is dedicated to help people inside the business make decisions. We also mentioned tax accounting, and we know the purpose of tax accounting is to help determine how much money is owed to the government for taxes. And then we also mentioned financial accounting. We are going to completely change gears now and focus 100% of our attention on financial accounting from this point forward in our video series. We already know that people inside the business organization prepare the financial statements or the financial reports. They prepare these financial reports primarily for people outside of the business organization. That doesn't mean that people inside the business doesn't use financial accounting reports, but the primary purpose of financial reporting is for people outside of the organization. So let's look at these people a little bit more carefully and try to understand why they want accounting reports. So primarily when we're looking at individuals for financial accounting or who uses financial accounting reports, we think of investors and creditors. Investors are individuals or businesses or governments who invest in another company. That means they buy shares of stock in another company. They actually own the company. So if you own shares of stock in another company, you're an owner of that company. We also have creditors. Creditors lend money to the business. The thing that both investors and creditors have in common is they have money, cash, which we also commonly refer to as capital, that they want to put into a business. The accounting reports help investors and creditors determine if they want to invest their cash into another business or lend their cash to another business. The financial accounting reports help the investors and creditors assess whether or not it's a good investment or good lending decision for them. We'll learn a little more about that as we go along. So we know that people inside the business organization are responsible for preparing the financial accounting reports. We know that these reports are given to investors and creditors to help them in their decision making, in determining whether they want to lend or to invest in the business. Given that people inside the business are making the reports, they have an incentive to make their business look as attractive as possible to investors and creditors. So we need to put some things into place that will increase the likelihood that these reports will be credible or believable and represent the underlying financial position of the company that is preparing the financial reports. So what do we do to increase the believability of these reports? First, the business has internal controls. We know that one of the objectives of internal controls is to produce relevant and reliable reports. We also have rules. By understanding the rules that are followed, investors and creditors can understand what the financial reports mean. We also have an audit by an independent CPA, CPA standing for Certified Public Accountant, and it's the responsibility of the auditor to examine the financial reports and determine if these reports are prepared in conformity with the rules or in conformity with GAAP. We also have regulations and laws and legal liabilities associated with failing to comply with the regulations or laws. Next, we want to turn our attention to the rules or generally accepted accounting principles. Generally accepted accounting principles are the rules that accountants follow when preparing financial accounting reports. Generally accepted accounting principles include the rules that are passed by standard setters. And in the United States, the standard setters are the Financial Accounting Standards Board and the Securities and Exchange Commission. The FASB is a private organization and the SEC is a government organization. Internationally, we have the International Accounting Standards Board, or the IASB. There's a global initiative to converge all accounting standards so that financial reports across the world will be prepared with the same rules, and so as a result, these financial statements can be compared. GAAP also includes the customs and accepted norms. Just because something isn't written down doesn't mean that it's not part of GAAP. In addition, GAAP changes over time. It's not stagnant. We're constantly updating the standards to reflect current accounting practices that relate to changing economic events. Now let's review. Financial accounting provides multi-purpose reports to external users to help them make decisions. That doesn't mean that internal users don't use the financial accounting, but the reason for financial accounting primarily is to support external decision making. Financial accounting reports are prepared in conformity with GAAP, generally accepted accounting principles. And financial accounting reports may be audited. Not all businesses have audited financial accounting reports. Remember, the accounting system is designed to meet the needs of the business, and not all businesses need audited reports. Preparing and disseminating fraudulent financial reports could result in legal liability. So now let's practice. Who is responsible for preparing the financial accounting reports? Our options are management, independent auditors, government, or the IRS. We know that people inside the business are responsible for preparing the financial reports, so our best option is management. Independent auditors, government, and the IRS are all external to the company, so they're not responsible for preparing the financial accounting reports. Who are the primary users of financial accounting reports? Our options are IRS and SEC, investors and SEC, creditors and IRS, or investors and creditors. While all of the agencies or individuals listed are users of the financial accounting reports, the primary users are investors and creditors. So option D is our best choice. Explain why it is important for users to believe the information contained in the financial accounting reports. So we have a free response question, and before we provide an answer, we want to think about why we prepare financial reports and who we prepare them for. We prepare financial reports for investors and creditors to help them in their decision making. They're determining if they want to lend or invest money in a particular company. So we need for them to believe the reports, otherwise they will not rely on the reports in the decision making, and the reports will be of no value. So our response could go something like, if users do not believe the information contained in the reports, they will not rely on it to support their decisions. The reports will be of little or no value. Our next question. List at least 4 things that add credibility or believability to financial accounting reports. There are a total of 5 things that we reviewed. The first, we have rules or generally accepted accounting principles, internal controls, laws and regulations, an audit by an independent CPA, and legal liability for failure to comply with the laws or regulations. So then our last question, why is financial accounting cool? Well, financial accounting helps determine who gets money. By determining who gets money, accountants rule the world.